We got a lot to digest today, so let's bring in Unlimited CEO and CIO Bob Elliott and Farr Miller Washington President and CEO Michael Farr. He's also a CNBC contributor. Gentlemen, it's good to have you. Bob, you're here with us on set. I'm going to kick this off with you because it's a perfect storm. You've got tariff implementation. You've got a very weak jobs report, this BLS firing, and then, of course, in the background, amid this Russia rhetoric, nuclear subs that are being repositioned to quote-unquote appropriate regions. Couple it with some seasonality. Is this to be expected today?
Well, I think we're basically seeing the market realize that the economy is quite a bit weaker than is currently priced into the markets. Like if you look at the bond yields before today, and you look at equity markets before today, we were basically at all-time highs in terms of stocks, and basically at cyclical highs in terms of yields. And the reality is there's been a building consensus of data highlighting the fact that the economy is slowing down. And I think in many ways, the jobs numbers today just sort of crystallized the reality that most people already knew if you were looking broadly at the data at hand.
Yeah. Michael Farr, does this set the table for a September rate cut, especially when you see the big move that Rick Santelli just outlined in bonds today?
I think that this is the plank that people are using to really strengthen their argument that we need those cuts. Things do look weaker. This employment data is coming out as weaker. And Jay Powell, I think the key here, Morgan, is that Jay Powell is not yet convinced. Jay Powell is still saying, look, you had 37% increase in imports in the first quarter, 30% decrease in the second quarter. That was a front loading and a wash. We have to see if tariffs are really going to slow the economy further or whether they're going to add to inflation. So everybody sees the stag part of the stagflation argument. And Jay Powell is saying, wait, I can't just raise rates into an inflationary environment until I see the whites of its eyes. But he sure isn't going to cut rates here. So I think the market, in anticipating a rate cut, is getting ahead of itself and beginning to listen to its own narrative a bit. I don't think Powell is convinced.
Bob, curious your take on some of this data stuff. Data really important for everybody to be able to trade on, to understand. It looks like federal employment was a big part of the revisions here. We all know what's been happening with Doge this year, and that hasn't happened before, so I imagine that's going to be hard to forecast. Also, I got questions about how much immigration, illegal immigration, the crackdown on that might be having an impact on these numbers. To what extent is this just a time of great change where it's difficult to forecast? If so, how should investors factor that in to how they plan things going forward?
Well, I think the revisions process with the payrolls report has always been sort of fraught with trouble in the sense of there's always a series of revisions that happen the next month and the next month, and then a bigger revision that almost typically happens, 9 to 12 months later. And so what we're seeing here in terms of these revisions are not all that unusual relative to the typical noise that we see, particularly in slowing environments. By definition, and process these payroll statistics, they sort of take longer moving averages. And so if we start to see a more abrupt deterioration, for instance, like we saw back in the 2008 period, often the initial reads will be a little lagging relative to the final reads. And I think that's basically what you're seeing here today. The good thing is, look, the president can fire the head of the BLS. They can engage in political manipulation around these statistics. The good thing is that there's a wealth of labor data that's out there in the market that's not reliant on political appointees and their belief in, holding up statistical standards. And so to the extent that the labor statistics, the payrolls get politicized, people will look at those other data from other areas, from other payroll providers, for instance, like ADP, and start to benchmark on those. And so regardless of whether or not those data get manipulated, the truth will be known, and the market will trade on the truth much more than whatever is reported by the government if it comes to be that case.
Challenging. Michael Farr, does this put the soft data in perhaps a different light, or perhaps it's a different value on it than we might have thought there was a couple months ago when we were wondering hard data versus soft data, which is more predictive of where we're headed?
Yeah, first, I think Bob's got this exactly right. I agree with him. And, yeah, the hard data and the soft data is left to some interpretation. And the bulls want to interpret it their way, and the bears want to interpret it their way. I think the big mistake that markets may have made over the past 5 years with the Federal Reserve is coming up with its own narrative. Markets are looking for the cuts. Markets are looking for the Fed to get in and intervene and make everything okay again. And Jay Powell, who doesn't have to keep his job much longer than 6 months, I think is being very circumspect and saying, hang on. So I think the real risk here is that markets are going to build an enthusiasm around a cutting narrative that may not come to pass. So you really need to pay attention to valuations. You really need to pay attention to the cost of money vis-a-vis interest rates, and really what these earnings continue to produce, and listen to the early messaging from a lot of the corporate CEOs about the challenges they're facing in order to produce and keep up profits in a time of increasing tariffs.